Kalshi has doubled down on commodities, signaling a bold bet on how investors manage risk in a volatile era. As inflation pressures, supply disruptions, and energy shifts reshape traditional markets, a dedicated hub for commodity bets could change how we price risk and hedge exposure. This moment matters because it connects retail confidence with institutional scale, turning once obscure futures like soybeans, copper, and LNG into accessible bets. Viewers will see why a regulated exchange expanding its footprint may influence liquidity, spread costs, and the incentives for information rivals to compete for accuracy and speed in real time. That shift could redefine risk management everywhere. To put it plainly, Kalshi is expanding its commodities trading ecosystem by launching a broader dedicated hub for commodity-based contracts. Investors will be able to place cash-settled bets on events like price direction, supply disruptions, and seasonal shifts in demand. Unlike traditional futures, these are binary-style outcomes with clear payoffs, settled by robust data. The expansion promises lower friction, faster onboarding, and a more transparent fee structure because everything trades on a regulated platform with published rules. In short, more assets, more liquidity, and more clarity about counterparty risk for both retail and institutional traders. This is a measurable shift. Historically, commodity exposure lived on open outcry pits or opaque over-the-counter networks, a world of brokers and brokers' fees. Kalshi arrived as a digital, regulated alternative exchange, aiming to simplify price bets on current events. In 2019 and 2020, the company secured support from futures regulators and launched a market that uses cash-settled outcomes rather than physical delivery. The new hub for commodities builds on that regulatory legitimacy while trying to address the complexity of energy, metals, and agricultural cycles. Investors recognize a familiar pattern: innovate, scale, and standardize to unlock broader participation. This heritage informs today's optimism and caution. Early reaction from markets has been muted but constructive, with commodity equities and futures trackers wobbling higher as liquidity ramps up. Traders note tighter bid-ask spreads in newly listed commodities and sharper two-way pricing as data flows improve. Kalshi's hub signals more credible price discovery, especially for nascent markets like LNG cargo swaps and weather-related energy bets. Risk premia appear to compress modestly as more participants enter, while regulators watch for robust disclosure. The net effect is a perception that the technology layer could lower barriers to entry and invite sharper competition among price reporters. Investors are watching liquidity parades widen. Embedded in this shift are the players who stand to benefit or lose. Exchange-traded funds tied to commodity bets could attract more assets, while producers and pipeline groups gain clearer hedging tools against price swings. Airlines tracking jet fuel and fertilizer producers seeking revenue certainty may adjust capex and procurement plans. Retail brokers could widen access to sophisticated commodity exposure, though they may confront new compliance dashboards. Banks and hedge funds already active in energy and metals find a broader, standardized marketplace that rewards speed, transparency, and robust settlement mechanisms. Small traders might finally compete with pro desks on time, accuracy, and fees. Rising global tensions, supply chain strain, and shifting energy policy frame this move as part of a wider macro mosaic. Commodities thrive on clarity and timing, yet political noise and currency volatility can distort signals. Kalshi expanding into a dedicated hub comes as central banks recalibrate inflation targets while China and Europe navigate industrial shifts. Weather shocks, harvest cycles, and grid reliability add volatility to underlying prices. In this context, a regulated, accessible venue for commodity bets could offer a transparent barometer for how the world perceives risk, liquidity, and future inflation paths. Policy signals will ripple through stocks, bonds, and options across regions. Smart money is quietly testing the water rather than shouting from rooftops. Hedge funds that chase energy and metal beta have started to revisit risk budgets, layering in commodity binary bets alongside traditional futures, options, and swaps. Endowments and pension funds savor the potential for improved liquidity and end-of-day settlement clarity, though they measure credit risk and regulatory compliance first. Retail platforms report rising new account openings in commodity betting, with education campaigns highlighting strategy, diversification, and position sizing. In every case, the signal is not hype, but iterative, data-driven experimentation. The next quarters will reveal which players translate interest into durable flows. Yet there are clear risks that could derail this momentum. Binary-style bets depend on reliable data and robust settlement, but data quality can lag during market stress, creating mispricing windows. If liquidity remains uneven, or if the hub attracts capital without adequate risk controls, spreads could widen and price discovery suffer. Regulatory risk stays real as new products migrate into commodity markets, inviting scrutiny over disclosure, leverage, and market integrity. Additionally, a sudden macro shock could expose correlations that catch investors off guard, turning a celebration into a scramble for collateral and margin calls. Risk capital could retreat if losses mount. Trust in new hubs wears thin quickly. For retail participants, the lesson is to approach Kalshi expansions with discipline and education. Start small, diversify across several commodity bets, and avoid over-concentration in any one exposure. Use tight stop rules and position sizing that aligns with risk tolerance and time horizon. Read the hub's fee schedule, liquidity metrics, and data disclosures, then simulate trades on paper before risking real capital. Seek independent perspectives from diverse data sources and track how spreads change with news. If a model seems too good to be true, test it in a controlled, incremental way and build confidence slowly. Patience and process beat hype every time. Across the spectrum, Kalshi's Commodities Hub could recalibrate how risk is priced and information travels from data centers to trading desks. The outlook leans toward deeper liquidity, sharper incentives to publish credible signals, and a broader audience for price discovery. Yet execution risk remains. Onboarding, data integrity, and regulatory alignment must keep pace with timelines. If markets reward transparency, then a dedicated commodities hub could accelerate real-world hedging, inventory planning, and capital allocation. Investors should watch for the pace of product launches, the quality of data, and the cost of participation. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.